I want to start this video with a very familiar image, one we've seen so often that we almost never question it. Every year, the Earth moves through 4 seasons: spring, summer, fall, and winter. No country skips winter, no continent lives in summer forever, and no year moves in only one direction. The economy works the same way. Every economy in the world, from the United States to Europe, Japan, and emerging markets, operates in cycles. And every cycle always moves through 4 phases, just like the 4 seasons of nature. Not because humans want it to, but because the mathematics of growth, debt, and trust make it unavoidable. The difference between people who lose money and those who preserve and even multiply their wealth is not whether they can predict the exact date of a crisis. The difference comes down to one much simpler question: do they know which season of the cycle they are living in? Let's begin with spring. Spring in the economy is not a beautiful time. In fact, it begins right after a major shock has already happened. It is the moment the economy emerges from winter, just after a crisis, when the system's top priority is no longer growth, but survival. Look at the United States after the 2008 financial crisis. When the banking system stood on the edge of collapse and liquidity froze, the Federal Reserve was forced to do something it had never done before in modern history: cut interest rates to near zero. On December 16, 2008, the Fed officially set the federal funds rate at 0 to 0.25%. This was not a growth stimulus, it was emergency medicine. But zero interest rates did not mean life immediately improved for ordinary people. In reality, the opposite happened. In 2009, U.S. unemployment surged to 10.2%, the highest level in decades. Businesses failed, workers lost jobs. The media was filled with pessimism and fear. This is spring in the economic cycle. The pain is still there, but the pain is no longer getting worse. One very specific behavioral shift begins to appear during this phase. Money in financial markets starts to change its behavior. After extreme panic, investors slowly move from sell at any price to find safety. U.S. Treasury bonds become a destination, pushing long-term yields very low. Then, as extreme fear begins to fade, long-term yields start to rise before short-term yields. In finance, this is called a steepening yield curve. In simple terms, the bond market is whispering that the future may no longer be worse than the present. What's interesting is that stock markets rarely wait for the news to improve. In this cycle, the S&P 500 bottomed in March 2009, precisely when unemployment was still rising and social sentiment was deeply negative. That is the nature of spring. Prices begin to reflect the future while people are still trapped in the past. Smart investors in spring are not trying to get rich quickly. They understand the system is still fragile. They preserve liquidity, avoid leverage, and begin accumulating long-term assets with discipline, not out of greed, but because valuations already reflect fear. During these post-crisis periods, Warren Buffett typically deploys cash into high-quality assets with extremely conservative terms. After 2008, he invested in Goldman Sachs and General Electric when fear was still widespread, but the system had the Federal Reserve behind it. Ray Dalio, during this phase, focuses on preserving the system itself, allocating more heavily toward government bonds and safe assets, consistent with his philosophy of surviving first. Then spring passes and summer begins. Summer is the phase when the economy runs smoothly, employment improves significantly, incomes rise, consumption returns, inflation stabilizes around levels the Federal Reserve considers healthy, usually around 2 to 3%. Media narratives shift from pessimism to optimism. Stories about growth, innovation, and opportunity become dominant. At this stage, the Fed is no longer in emergency mode. Interest rates may remain low for a time or rise very slowly. Credit becomes easily accessible. Businesses expand operations. Households borrow to buy homes, cars, and invest in the future. Look at the United States in the years after 2009. From 2010 to 2014, unemployment steadily fell from above 10% to below 6%. Stock markets rose consistently. Real estate recovered. Confidence returned. This is summer, the season when most wealth is created. But summer has a dangerous feature. It convinces people that good weather is the normal state of the world. When conditions stay smooth for long enough, debt begins to grow faster than income. Not because anyone is evil, but because the system encourages it. When money is cheap and confidence is high, leverage becomes tempting. Smart investors in summer still participate in growth, but they never forget that no summer lasts forever. They begin building safety buffers, reducing dependence on debt, and closely watching for signs of seasonal change, even while most of the market sees no risk. During this phase, Buffett allows businesses in his portfolio to compound naturally and avoids chasing bubbles. Ray Dalio maintains a balanced portfolio, capturing growth while keeping defensive layers in place, because he understands the cycle has already moved into its second half. And then, quietly, fall arrives. Fall is the most dangerous phase of the entire cycle, because on the surface, everything still looks fine. Employment is strong. Unemployment is low. Incomes are rising. But beneath the surface, the system is stretched. Look at the United States before the 2008 crisis. In 2007, unemployment stood around 4.6%. Many viewed this as proof of a strong economy. At the same time, inflation was heating up. At certain points, U.S. CPI exceeded 5% year over year. The Federal Reserve was trapped. If it did not raise rates, inflation would spiral. If it did raise rates, the debt-based system would come under pressure. The Fed chose to tighten. The rate hiking cycle from 2004 to 2006 pushed interest rates up to 5.25%. And this is when the bond market began sending a signal many people ignored. The yield curve inverted. Meanwhile, stock markets continued rising. The S&P 500 reached a new high in October 2007, but volatility increased noticeably, with multiple 5 to 10% corrections throughout the year. Real estate began cracking as early as 2006. Gold rose from roughly $560 per ounce in 2006 to over $1,000 by 2008, not because of emotion, but because inflation was high and trust in the monetary system was starting to erode. Smart investors in fall do not wait for the crisis to explode. They reduce risk step by step, cut leverage, and shift from debt-driven growth to quality-driven preservation. Before 2008, Buffett held record levels of cash and refused to chase the market. Ray Dalio consistently warned about systemic risk and reduced exposure to risky assets, famously saying that the biggest mistake investors make is believing that what happened in the recent past is likely to continue. And then, what cannot be avoided arrives: winter. Winter is when all imbalances are exposed. The leverage accumulated during summer and fall can no longer withstand pressure. The system is forced to deleverage, and that process is always painful. During the 2008 to 2009 crisis, U.S. unemployment jumped from 4.6% to 10.2%. The stock market collapsed roughly 57% from peak to trough. Real estate froze. The Federal Reserve returned to emergency mode with zero interest rates and massive quantitative easing. In the 2020 shock, winter arrived with shocking speed. In just weeks, the Fed's balance sheet expanded by trillions of dollars, a clear demonstration that liquidity had become a matter of survival. In winter, U.S. Treasury bonds become a safe haven as capital flees risk. Gold continues to rise as confidence in the financial system is tested. Buffett is only greedy when others are fearful after he has survived winter with strong liquidity. Ray Dalio, in this phase, focuses on avoiding permanent loss of capital because, as he often says, you don't need to make money back the same way you lost it. And this leads to the final conclusion: the economic cycle is not something to predict. It is something to respect. You cannot eliminate winter, but you can avoid freezing to death in winter. You don't need to know the exact day a crisis will happen. You only need to know which season you are living in and act in a way that fits that season. Because in investing, the winners are not the smartest people in the room. The winners are the ones who move in rhythm with the cycle.